Hello, this is going to be a super brief yet informative presentation teaching you the right way to trade. Just a quick word of caution, I advise you only use the principles you learn in this presentation on the euro dollar, the euro USD, as it is the most traded currency on Awanda, therefore the order book is super accurate. Other currencies aren't traded well enough for the order book to show an accurate representation of the overall market. Alright, let's get right into the fundamentals. You may have heard this quote before. 90% of retail traders lose 90% of their account within 90 days. After watching this video, you should have a clear understanding of why this happens, but most importantly, you should learn how to always be in that profitable 10% and how to steal money from the 90% of retail traders. So the fundamentals of order flow are that in order for someone to make money, someone has to be losing money. And this is entirely true. Whenever you earn money in Forex, it doesn't come from a magical money fairy. It comes out of the pockets of someone who just lost money. In order for price to go up, retail traders have to be selling. In order for price to move down, retail traders have to be buying. And the beauty of it all is that retail traders all think the same way. They all trade using moving average crossovers, support resistance, trend lines, and all that fugazi. So the sentiment is usually one-sided. And this brings us over to the first tool you need to use, the IG client sentiment. This tool will effectively allow us to see what retail traders are doing so we can do the opposite. IG is also a broker like Awanda, and they have a cool website called www.dailyfx.com/sentiment. This website is super neat, and it basically summarizes what retail traders did that day. It gets updated every hour. On top of that, uh, it gives you an overall position ratio, but that isn't a daily indicator. What you have to look at is the percent change. So for example, if 4% of retail traders closed their short positions and 11% of retail traders went long, then price will move down that day. Regardless that the overall sentiment is 64% short and 36% long. By the way, they even have their own indicator that shows you a bullish, bearish, or mixed signal, and that signal is against the majority. Use that signal as confirmation. Don't really use it as an indicator, and don't worry if that signal is mixed. So with the sentiment, we basically know what position we are looking to take for the day or night, but now we need to know when do we take that position, as that is just as important as anything else. It is important that you place your trade before the London Open banking session. This is where the banks in London wake up and start stealing money from the retail traders. But don't worry, they just like you always trade against the majority. This session is at 8 a.m. London time, so convert that to your local time zone and enter 15 minutes before London Open. 8 a.m. London time. Alright, let's look at the final tool that you need to use before we look at a couple of examples. This tool is the Awanda order book. To access the order book, you simply go to www.trade.awanda.com. By the way, you would need to have a live account set up with Awanda, and if you don't have one, that's fine. You can set one up. It's completely free. Alright, and you don't even need to deposit any money. So once you go to trade.awanda.com, you click right here. You select the order book and make sure that you choose the net setting. Alright, the net feature. The non-cumulative feature shows you all the orders, while the net feature shows you the net order on the price. So the non-cumulative looks like this, the net looks like this. Alright, we use the order book for one simple reason and one reason only, to see the stop losses of the retail traders. Now, in order for you to close a buy position, you need to sell. Therefore, a stop loss for a buy position is a sell order, and it is placed below current price. So right here, for example, this is a stop loss for a buy order. Similarly, in order to close a sell position, you need to buy. Therefore, a stop loss for a sell position is a buy order located above current market price. So this one right here. We use these stop losses to set our take profits. So when we trade, we would set our take profits at the levels of those stop losses. Why, you may ask? Well, let's dive a little deeper into order flow and take a look at how institutions make money. Those are the big players, the smart money, the firms, the hedge funds, the corporations, all those big guys. Let's say that once upon a time, retail went short on Euro USD. Institutions see this, and they have access to an order book as well. Their order book is even better, and it's even more accurate. So, when institutions start their workday at 8 a.m. London time, they would be buying the Euro USD. Since retail traders went short, they would be doing the opposite, so they would be buying the Euro USD. This causes price to go up as they have large amounts of money and are very capable of moving the markets. They would keep buying until price reaches the stop losses of the retail traders that went short. Now, institutions want to close their positions and take their profits. Because they went long, to close, they need to sell. If they would sell randomly, price would start falling as they sell and close their buy positions, and their profits would disappear as they close their buy positions. To keep their profits, someone needs to be buying as they are selling and closing their positions for price to remain at the same level. The stop losses of retail traders that went short that day are buy orders, because remember, in order to close a sell position, you need to be buying. Therefore, price won't be falling as institutions close their positions because of the stop losses of the retail traders. Okay, so let's do a quick review of what we have learned so far. First of all, we trade with the institutions. And when do institutions start trading? They start trading on London Open. So we usually would we would enter a position 15 minutes before London Open. Uh, and remember, London Open is 8 a.m. London time. Next, we want to look at www.dailyfx.com/sentiment to see what retail traders did during that day. Remember, we do not look at this, we look at this. Alright? If, for example, 11% of traders went long and 4% closed their short position, we would be opening a short position 15 minutes before London Open. After we have determined what retail traders did that day, we want to trade in the opposite direction. So, if 11% of traders went long and 4% closed, we would be doing a short position. Finally, we take a look at the order book to identify at which levels the retail traders place their stop losses, and that's where we put our take profits, at the levels of those stop losses. Remember, if you are going short, you would set your take profits at the levels of the stop losses of buy orders. So if you're going short, you would be looking for the gray bars, and that's where you would be setting your take profits. If you are going long that day, you want to be setting your stop losses at the levels of the sell orders. So if you're going long, you want to set your take profits at these levels, at the blue lines sticking out. Okay. Yes, it is that simple. It's like stealing candy from a baby. But just so that you fully understand the concept, let's take a look at a quick example. Here is what price was doing 15 minutes before London Open. That day, if we look at the client sentiment, we see that 17% of traders went long and 25% of traders closed their short positions. That day, we were also given a bearish signal so that you know price will go down during London Open. And next, we want to take a look at the order book. we see that the retail traders place their stop losses at 1.1793. Now, guess what happens 6 or 8 hours after London Open, after we place our short trade? Boom! Price went straight down, right to the stop losses at the 1.1793 level. Just completely obliterated all the traders that went long that day. So yeah. Well, that's it. Please do not share this video with anyone, as the concepts will stop working once everyone figures them out. You will make a lot of money with this information, and if you want it to stay that way, the knowledge you have learned has to be kept secret. Please do not ruin this for yourself and for me, and I hope you enjoy your profits. Peace.